This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Simon back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Simon's picture saying looking for the downloads. All right, Eric, let's start off with your thoughts here on the equity markets.
Well, Patrick, I am really kicking myself for how I handled the whipsaw that we all just experienced in equity markets. And I don't mind publicly admitting how badly I screwed this up because, frankly, I'm pretty confident that I did better than most. I think that what we're going through here is a deer-in-the-headlights moment in market history where professional investors simply aren't taking the risks that have already been made plain as day clear to heart. Ever since the end of January, I've been rolling my eyes and shaking my head at other investors when I read their comments, presuming that there's a magical Trump put under this equity market. And I'm just shaking my head in reaction to the general level of complacency that's existed in the finance community ever since the election. Look, this couldn't be more clear. President Trump and Secretary Bessent told us in plain English multiple times that they have major plans involving aggressive tariff policy. They want a lower dollar and lower bond yields at the long end of the curve, and they're willing to sacrifice the stock market in order to achieve those goals. In other words, they warned us multiple times that this was coming, but nobody listened. I privately ridiculed other investors for being too complacent and not taking this clear message to heart. But did I adequately hedge my risks? No. Why not? Well, I guess because, like everyone else, somehow I managed to subconsciously downplay the extent of market risk that was being created by Trump and Bessent's very clearly telegraphed plans to get aggressive with tariffs. Now, yes, I hedged downside risk in my portfolio, but I did that with put spreads rather than outright puts, and with a lower strike price of $52.50 on the June E-mini S&P futures contract. Now look, the reason that we sometimes get fancy and use put spreads rather than outright puts is because we like to tell ourselves that we're smart enough as professional investors to use technical analysis to tell us what the downside target's going to be, knowing that it can't go any lower than that because we're so smart we know where the levels are in the markets, and we can save money by hedging more efficiently with spreads than with outright puts. Well, that line of reasoning ignores the true nature of the risk that we're hedging against. The name of the bull in this China shop is Donald Trump. Anyone who thinks that technical analysis is going to determine where a market move ends in reaction to Donald Trump prosecuting his agenda that he went out of his way to warn us weeks ago was coming and would jeopardize the stock market. If you think technical analysis is going to keep that under control, you're crazy. But I still hedged with put spreads rather than outright puts, and my lower strike ended up being several hundred points above the actual market bottom. Now, in fairness, I can't say all professional investors screwed this up. Patrick, I've got to hand it to you, buddy, because you perfectly called this. You told our MacroVoices listeners several months ago when the S&P was still at all-time highs that it was time to hedge. Then you covered your shorts on Monday right at the market lows and went aggressively long and participated from the long side in this huge reaction move up. Needless to say, you and your subscribers were very well rewarded for playing this perfectly. My hat is off to you, and I wish I had followed suit. And for anyone who doubts that chronology, it's all documented in Patrick's YouTube channel videos, which are completely free. But for the rest of us who frankly should have known better and didn't hedge adequately for the extent of what just happened, I think we should reflect a little more on the lessons learned. The biggest point I want to make now is this isn't ending. This battle does, in fact, appear to be ending, but it's the first of many battles in a war that will likely be waged for years. And just in case anyone still isn't listening, Trump and Bessent have said clearly they are willing to sacrifice the stock market in order to achieve their goals. If you didn't get that memo the first 5 times, and I admit that I didn't, it's time to take it to heart now. I am still today reading professional commentary about how the market just found a strike on the Trump put. Bullshit. That's not what happened. I couldn't possibly disagree more with that interpretation. I say what just happened is that it just got even clearer that there is no Trump put under this market. Trump is going to do what he wants to do in his heart of hearts to make America greater again in his interpretation of what that means. Just look at what happened on Monday. After someone leaked a rumor that Kevin Hassett, director of the National Economic Council, supposedly said on Monday that Trump was mulling a 90-day ceasefire on tariffs, the S&P shot up over 300 S&P points in 6 minutes. Then as soon as the White House said it was fake news, the S&P retraced the first 200 points downside in 6 more minutes, and then it took another 15 minutes to fully retrace all 300 points back down to the downside. Now, I, for one, don't believe that that was fake news. I think it was an intentional trial balloon, intentionally staged by the Trump administration to test how the market would respond to a 90-day ceasefire on tariffs announcement. That's speculation on my part, and I certainly can't prove it. But when you consider that the exact thing that Trump really did announce on Wednesday was identical to the supposedly fake news that we had on Monday, it seems highly suspect, to say the least. So the point I think everyone should really take to heart is Trump and Bessent are engaged in guerrilla warfare. And if I'm right, they don't think twice about intentionally whipsawing the S&P up 5.5% in 6 minutes, then back down to a full retrace in the next few minutes after that. They're not worried about the damage that that does to traders, nor do they think twice about the fact that they knew all along that their tariff negotiation strategy would do this to the markets. Their response to that is not to avoid hurting the market. It was to tell us in plain English that they were going to do this so that we would have the opportunity to hedge our risks appropriately. I, for one, didn't take that message to heart, and I learned my lesson from that. So the message to take to heart now is they won't hesitate to do the same thing again, or even something more disruptive to markets if that helps achieve their bigger picture goals of how they want to restructure the monetary system and balance of power in world trade. So what that means for those of us trading markets is we're playing soldier in a hot war zone where people with bigger guns than us are going to continue shooting live rounds over our heads. Okay, had to get that off my chest because I, for one, feel like a complete fool. I fully understood all of this. I made fun of other people for not taking Trump seriously, and then I didn't hedge adequately for what just happened. There is no Trump put, folks. Anything can happen here. Patrick, now I'm going to put you on the spot since you can afford to be on the spot, having just made a fortune in both directions on this trade. For someone with my views, which is, look, I obviously the battle is over. We're very much momentum is now up with this 90-day ceasefire. I want to wait out this giant sigh of relief bounce that's now underway in markets. But whenever we get to a point of a top on this sigh of relief here, I want to figure out how to hedge and fully hedge my risk. And I don't mean just against the next little whipsaw that might come in the next week or two. I'm talking about putting on a hedge that will protect me from what could be several more of these events in coming weeks and coming months. I'm hesitant to again use put spreads, mostly because they don't fully realize their potential until just before expiry. Because of the time value still on my put spreads, I ended up only realizing about 2/3 of that difference, even though the market was trading several hundred points below my lower strike. So, and people who understand options understand why that's the case. So I think it's outright puts. Well, gee, I think outright puts just got a whole lot more expensive here. So, Patrick, give me an upside target on the S&P for where you think I should start scaling into a new basket of downside hedges, and tell me in professional investor terms how to best structure a hedge hedge now that the jig is up, and I'm obviously no longer likely to have the opportunity to buy E-mini S&P future puts at implied vols in the teens like we had the chance to do when you first recommended it to our MacroVoices listeners?
Those are all great questions. So let's break this down. First of all, what are the levels we should be looking for? Well, the interesting part is we already hit some of the upper levels that we were originally expecting this market bounce to go to, like the 5,500 to 5,700 area. I mean, can the market go to 5,800? For sure it can. But generally, once we're in that 55 to 5,700 zone above on the S&P, those are all levels where once again it becomes tactical to be considering new hedges. The type of hedges that we put on is going to be very reliant on where we are in volatility. And right now, with the VIX still up in the 30s, it is very challenging to just buy a straight out put option like you were suggesting. And you were also talking about some of the downfalls of using spreads. Well, there's a couple considerations when hedging with spreads. One, do you decide that you want to hedge for your return at end, which is that you're willing to hold the spread till its expiration, in that it will be in the money and that intrinsic value will be captured as a way of reducing the overall losses you're incurring on other investments. But when you're being tactical with the intention of closing the spread halfway through at a moment when the market hits a particular target, like you suggested, you are a point where you're not realizing the full profit potential of that spread. And that's normal. So one of the things that I often do is that if I know that I'm going to be tactical about a spread hedge, then I estimate what will be the profit of that spread when those target levels are being hit. And if I feel I need more hedge, then I'll just simply buy more spreads to ensure that your total dollar payoff at a tactical time is what you were originally targeting. Now, overall, this environment still is one where spread trading is a more tactical way of approaching your hedges, especially at these elevated levels of volatility. But it's not just volatility, it's also the skew. We have a very steep skew in the markets where those really far out of the money puts are paying rich premiums, making the spreads usually have very good payoff profiles. One of the things you can do is simply widening the spreads even further. Rather than, let's say, doing a 500 S&P point wide spread, you might end up doing 700 or 800 point spread to allow there to be more room for intrinsic value to be built. And you're often not sacrificing a lot in widening that spread because of the steepness of that skew. And so this is where I still think the spread trades are a way to go. Now, if you want all of the downside gamma of a protective put, then the alternative is that you will go back to a collar strategy like we talked about, selling call premium in a way to help finance the cost of the downside put hedges. It's a way of offsetting some of those costs. And in a period where if you are in the mindset that this isn't over and that there's more vulnerability to the markets, then selling some of the upside away, especially after a huge rally like we've seen, is something that may be acceptable to many investors. Lots of really different ways to approach it. But I would say as we get here in the next week or two to levels on the upper end in that 5,700 give or take area, is a level where it does make a lot of sense to re-engage hedges going into the summer. Now, I wanted to quickly look at the charts on page 2 here, Eric, and I wanted to show that the S&P 500 bounced right off of that 5,000 level, right at the level where we highlighted for members just last week. Now that we've got this bounce in the market approaching that 50-day moving average up above and the Fibonacci retracement zones, this is going to be a level where once again we should see the market start to struggle with overhead resistance and be far more trade range bound. Now, while I don't see a huge upside in the market, it is also likely that we could spend weeks grinding up here, and that the most immediate downside risk is not as highly probable, and because just the market is so exhausted from the selling and having discovered all these lower levels, it often spends time consolidating these things in. And so we'll be looking for where and how far this rally goes to project out where are some of the further downside targets going into the summer if this does end up being something much more like a bear market. On page 3, I have that volatility index, and one of the things that spurred me to profit take when I did was the huge spike in volatility. We have not seen a spike of volatility of this magnitude since COVID, and then you have to, before that, go all the way back to the financial crisis. The type of volatility spikes was extraordinary. Typically, this is that fear moment in a market where short-term lows are established, and the VIX really this time around did help identify that very moment. And so I think that there's a very good chance here now that volatility could consolidate back into the 20s. But one of the things that will be a big tell for me, Eric, is whether or not volatility consolidates in the 20s or whether or not we go back into the teens. Because if we see volatility go all the way back under 20 down to the 18 or 19 or something like that, then that would actually increase the likelihood that a major low could be in and that the market is pivoting. But if we see sustained higher levels of volatility where the market is rallying even for several weeks and just holding up at these zones, but volatility stays at 25 or 27%, then that tells me that that there's a lot of nervousness in the market and volatility premium is staying high for a reason. And that would be a bit of a warning for me. Nonetheless, thanks for the plug on the YouTube. People that want to watch my Monday macro outlooks where we called all of this stuff, just go to my channel, Patrick_Ceresna on YouTube. All right, Eric, let's move on to the dollar. What do you see here?
Well, we've established a clear downtrend, and I expect it to continue. Obviously, upside vol is possible in this crazy market environment, but over time, I expect that if the president wants to devalue the U.S. dollar relative to other currencies, he will succeed at doing so. And he's in good company with Scott Bessent showing him how to do it.
So, Eric, on page 4, I have that chart of the dollar index. And one thing that is very evident technically is the distribution continuing. All rallies are failing, and the path of least resistance remains to the downside. A number of these different measured moves line up perfectly with all the previous lows. So at this stage, a dollar index going back down to the 100 handle would be very natural, and that would be a euro testing the 112, 113 areas up above. And at this stage, when we get there, it'll all be about how the dollar settles in. That will, in my mind, set up for whether or not the dollar is starting some really big bear market or whether this was just a big trade range and we just went to the bottom of the trade range and then settling back into the middle. All right, Eric, on page 5 out of the crude oil chart, and well, what a move.
We got all the way down to a $55 handle on WTI before Wednesday's ceasefire news obviously turned everything around. I was looking at that, telling myself, wow, 55, that's too cheap to resist. I ought to buy this, and almost did, and turned around a few minutes later, and it was already 60. So I missed it by that much. Congratulations to anybody who caught the bottom there. What I think is really profound, though, is not how low it got, but even at $55 WTI, we still had modest backwardation across the first year of the forward curve. That's really saying something. After a flat price sell-off this pronounced, the term structure usually collapses into contango. So what this says to me is that we still have reasonably tight supply, despite the fact that we're being pushed into these really low numbers. So the fact that it was still in backwardation at 55 made 55 all the more attractive. Wish I bought it, missed it. Congratulations to anybody who caught the bottom while it lasted.
Yeah, extraordinary breakdown of close to $17 from peak to trough before we got ourselves a bounce. Now, we are overdue for a bounce, and it would not shock me here, Eric, if we got back to $63 to $65 on crude oil. But there's a rule in technical analysis where what were all the previous lows, when broken, act as overhead resistance. And it is very likely that when oil approaches that $66 area where the lows over the last 6 months were being established, that will now act as an overhead resistance, and oil will likely be at this new lower level for at least a few months into the summer until we see the dust clear in terms of the prevailing trends, and then see whether oil actually puts in a low here or whether there's going to be more selling in a recessionary environment. All right, Eric, let's touch on gold.
Well, this correction appears to be over, to say the very least, with gold now up more than $150 off its lows in just 2 days. But let's not forget Rick Rule's famous words on gold. When gold is doing this well, it's nothing to celebrate, even for those of us who are fortunate enough to be profiting from being long on the trade. What it means when gold does what it's doing right now is that the financial system is falling apart at the seams and the dollar's reserve currency status is at risk. I'm still glad to be long rather than short in this gold market. Wish I hadn't taken off some of my size a few weeks ago. But the reason that this is happening is because everyone is starting to question the long-term stability of the entire global monetary system. Yes, it's great to be on the long side of gold, but it could also be the harbinger of worse things to come.
Well, Eric, what was interesting to me about gold was that it was only when the stock market had started suffering from a liquidity drain that gold finally started to sell. And the pullback basically came straight to the 50-day moving average, right to the fib retracement zones. And as soon as everything stalled, gold ripped right back towards its highs. So far, gold remains in a very clear bull market. A pattern of higher highs, higher lows continues. Old dips are being bought, and it actually is doing incredibly well. At this moment, I don't know whether I want to say some sort of bold upside target, maybe retesting of 3,200 or 3,300 target maybe on the upside, but it is certainly behaving as a safe haven. It is holding a primary trend, and it continues to be one of the few things that are working. So what's interesting, though, was the big sell-off in silver, and silver got hit by, I guess, far too many investors being leveraged in the play, and there was just one big squeeze in that silver market. What's interesting about that is that gold seems to almost be marching to the beat of its own drum now, as a lot of the other precious metals got hit with the liquidity and never recovered the same way. So to me, that implies that gold may hold up here well, but it may not have an extraordinary upside. All right, Eric, let's touch on uranium.
Well, I tried to promise myself not to buy any more uranium because I'm already ridiculously overweight and the trend was obviously already down. But I just couldn't resist another million shares of Lotus Resources at 13 cents. That's only $78,000 U.S. equivalent for a million shares, and all it has to do is go back to its previous cycle high in order to be a quadruple from here. It's already up 20% since I bought it on Monday. I also couldn't resist buying more Silex at $2.80. Silex is the laser enrichment company based in Australia that's building the big laser enrichment facility in Kentucky in the United States. Laser enrichment is the new replacement for centrifuges. Experimental stuff, but super exciting. Anyway, as much as I shouldn't be buying more uranium because I already have too much, I couldn't resist. Another round of Trump tariff mayhem could easily take us to lower lows. The trend is definitely still down. We have not yet seen any technical signs of a reversal yet, so I'm probably early to be buying here. I've been guilty several times on the way down of doing that. I can't help myself because the longer-term fundamentals just couldn't be better. But the technical trend is still down, so probably the smart thing to do here is wait for clear signs of a new uptrend. But boy, when this thing starts to go, there's going to be tremendous upside.
Interestingly, Eric, the Sprott physical did sell, but that was largely probably due to people raising cash. But it really was simply increasing the discount it's trading to its net asset value. Uranium itself didn't seem to move that much during this whole period. And overall, uranium has actually been relatively quiet compared to some of the other commodities out there. So let's move on to copper.
Patrick, I see kind of a conundrum here. On one hand, Dr. Copper is one of the most reliable recession signals that there is. And after 25% down in 2 weeks, that's a screaming loud recession is imminent signal if ever I saw one. But wait a minute. There can be no question that what got us all the way up to 550 on copper in the first place was traders front-running Trump tariffs. And what got us all the way down to 420 was traders reacting to Trump's tariff tsunami. So was that a real recession signal that we should take seriously and that we can't afford to ignore? Or was this so distorted by traders gaming the tariff announcements that it doesn't really count as a fundamental recession signal? Well, I could argue either side of that, and frankly, the truth is I'm not sure. But what I am going to do is to keep watching this carefully because, look, if copper retraces, rebounds, and with the same exuberance that we're seeing in equities now and retraces to the upside proportionate to the equity market retracement, okay, that's one thing. That says to me maybe this was just a lot of traders gaming tariffs and it didn't really mean anything. But if copper lags behind here, as appears to be the case so far, it really strengthens the argument that this is a very important imminent recession signal that we should not ignore. And if that's the case, it could very well mean that the final low is not in yet for the stock market. So I'm definitely going to be taking your earlier hedging advice to heart, Patrick, and thinking about how to hedge my equity market risk going forward. Copper, to me, seems like it's kind of a canary in the coal mine here.
Well, Eric, we just basically saw an Eiffel Tower formation develop on copper as it literally gave back the entire year's gains in one fluid motion, a 20+% drop. But we are now back to the lows where we were trading for over 6 months throughout the summer of last year, all the way to the start of the year. And this area certainly can offer technical support for the short term. But whether copper has another leg down, I think will be obviously about this, whether we have this negative feedback loop in the markets that spurs another wave of selling in the months to come. And right now it's at a support line, expecting a bounce. We could likely see 450 to 475 on a reaction to the upside. But I'm not eager to be rushing in to buy the upside of copper, at least until the dust settles and we see some new bottoming formations develop over the next couple months. Finally, I just wanted to touch on the SOFR and Treasury charts. And the SOFR futures chart that I have up here, which is the December 2026, we saw interest rates approaching 3%, basically anticipating some further Fed cuts coming. But after the FOMC meeting minutes, this quickly receded back down. We're at a stage where clearly they're anticipating that the Fed will have to be more dovish in the quarters to come. But at least at this moment, it's a struggle in this market to determine how dovish the Fed will end up being or having to be if the situation continues to deteriorate. On page 10, I just have that long bond, the T-bond futures. And what we can observe is extraordinary volatility for one day. But what was particularly interesting about it was we saw once again a scenario where bonds were selling at the same time as stocks. And that is not something we commonly would have seen in decades past. And it was something we did see a lot of in 2022 when inflation and other bond bear market scenarios were developing. Now, with a breakdown like this, one of the big things for me will be, will we see this quickly recover recover. Maybe it was a bit of stress from the basis trade unwinding, and then when settled down, will we see these bonds recover, or is this the start of some new round of selling? It's a little premature to jump to a conclusion, but this is a very interesting moment that we have to watch carefully to see how bonds react in the next 1 week.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.